Welcome back to The Explainer. Today we're diving into GoldMining Loonie Week 25, the reset before recovery. Look, we're stepping away from the profit celebrations today. Instead, we need to talk about something much more critical: survival. There is a saying that sometimes winning simply means knowing when to take a massive loss just to survive and trade another day. And that really hits the nail on the head for this week. This analysis isn't about how much money was made. Not at all. It's a calm, totally transparent look at the absolute harsh reality of risk management when you're under intense market pressure. We're looking at what happens when a market trend violently turns against you. It is so easy to just hold on to hope, right? To sit there waiting for a market reversal that honestly might never come. But professional risk management, it requires a much colder, more mathematical approach. It means having the discipline to look at your expanding exposure and literally pull the plug before a drawdown turns into a completely blown account. So let's get right into the undeniable heavy statistics of week 25. A weekly gain that actually ended up being a steep loss of minus 35.42%, a realized loss of over 1,173 cents, and an overarching lifetime growth that got dragged down to minus 13.30%. We're giving you a radically transparent look at the facts here. No marketing fluff, no hype, no unrealistic optimism. Just the objective documentary-style reality of what actually happened to this cent account on its long road to the 10,000 cent target. To understand exactly how we arrived at those numbers, we really have to zoom out and look at the broader macroeconomic landscape. The market doesn't move in a vacuum, right? Throughout the week, a relentless fundamental storm was brewing. We had shifting Federal Reserve expectations mixing with surging U.S. bond yields, and that basically injected massive strength right into the U.S. dollar. And at the exact same time, shifting oil market behaviors and broader risk sentiment led to some severe Canadian dollar weakness. Put that all together, and you get a hyper-aggressive, one-sided environment. The fundamental forces were just perfectly aligned to push the US dollar to Canadian dollar pair higher and higher, basically acting as a freight train coming straight at the account's existing strategy. Now, when you break it down to the 15-minute time frame, you start to see exactly how that macro environment trapped the strategy. It was just a steep, completely uninterrupted bullish trend. The strategy was placing sell orders, trying to capture a retracement. But guess what? That retracement literally never came. The market just kept pushing higher, fueled by all that US dollar strength we just talked about. So the strategy's sell basket became fatally trapped by this totally unstoppable upward momentum. Every single time the market made a new higher high, it meant the account's risk profile was expanding. And as that market continuously pushed higher, the floating losses in that trapped sell basket rapidly expanded. Now, this isn't just a psychological burden, it's a very real structural one. The account's equity pressure built up to a critical threshold. You eventually reach this mathematical breaking point where the margin required just to hold those losing positions starts threatening the entire foundation of the account. So the risk of holding out, just hoping for a reversal, mathematically outweighed the pain of simply accepting the current loss. Immediate action was absolutely demanded. And that intense mathematical pressure is what forces you to act. Let's look at the anatomy of pulling that plug. Reviewing the stark red trade history with a really clinical lens reveals the painful but necessary closure of those trapped orders. We're talking about closing out heavy 0.58 and 0.28 lot size sell orders at severe losses, minus 269 cents here, minus 329 cents there. This is what professional risk management actually looks like behind the scenes. It's not always glorious, easy profits. Sometimes it's manually executing the closure of your absolute biggest losers just to reset your exposure and stop the bleeding. Minus 1,173.20 cents. Let's just pause for a second and let the exact cent value of that realized weekly loss sink in. When you're trading a $25 cents account and your long-term goal is to reach $100 or 10,000 cents, taking a loss of over 1,100 cents is a massive structural hit. There's no way around it. But authentic trading requires you to face these raw numbers without sugarcoating them. You can't manage what you refuse to acknowledge, right? Accepting this specific number was basically the mandatory price of admission just to keep the account alive. The result of that decision is a brutal vertical cliff drop in weekly growth. It plummeted to minus 35.42% for the week. Imagine the psychological toll of taking such a severe hit after spending months trying to build up steady progression. The growth just plummets and flatlines right at the bottom. But here's the thing, while that flatline looks totally devastating, it actually represents stability. The free fall was intentionally stopped. The bleeding was halted the exact moment the decision was made to close that basket. If we break down the exact components of that damage, we see what was essentially a dual front attack. The vast majority of the impact, of course, was a gross loss of over 1,100 cents from the closed trades themselves. But we also have to factor in the negative swaps, minus 91.33 cents just in swap fees. Because the account was holding those losing sell positions open for an extended period, rolling across multiple market days, those negative carry costs just compounded the damage. So the equity was literally being attacked from two sides, the market moving against the position and the broker charging a fee to hold it. Now, it's absolutely vital we transition from the localized, specific devastation of week 25 to how this whole sequence of events infected the overarching statistics of the entire challenge. We have the localized weekly trauma of a minus 35% performance. But because this account had actually built up some prior resilience over time, the lifetime impact, while still severe, sits at a minus 13.30% total growth. So yes, the account is now net negative since its inception. The progress from the previous months has basically been wiped out, which forces a complete ground-up psychological and mathematical reset. You can see this reality crystal clear when tracking the lifetime balance and equity divergence. Right at the very end of the timeline, there is a severe, sharp downward drop where both balance and equity sync up and just plummet. That drop is the direct, undeniable consequence of the week's risk management decision to close out the basket. All of that steady, incremental climbing we saw throughout the earlier months, it just abruptly drops off. It is a very stark, sobering reminder of exactly how quickly leveraged exposure can completely unwind your progress. So, what's the actual damage? Where does that leave us today? Well, here are the cold hard facts of the account's current standing. Total lifetime growth is currently sitting at minus 13.30%. The maximum drawdown experienced has spiked up to 33.13%. The total balance remaining is 2,139.11 cents, and the equity is sitting just below that at 2,128.81 cents. By sticking strictly to our documentary style here, we are giving you these numbers exactly as they are. This is our new baseline. This is the battered but stable foundation from which the strategy has to attempt to recover. Let's talk about that lifetime drawdown spike for a second, plunging down to reach 33.13%. Look, a 33% drawdown is severe territory for literally any trading strategy. It hurts. However, the absolutely crucial takeaway here is survival. Executing the loss, as agonizing as it was, prevented this metric from dropping further to 50%, 80%, or total terminal failure at 100%. The intervention actually worked. The account bent, it took some incredibly severe damage, but it did not break. And that reality completely shifts our narrative toward resilience. The account is bloodied, for sure, but it is alive. This $25 account remains fully operational. By actively accepting the loss, that toxic exposure to the relentless USDCAD bullish trend was completely reset. The margin has been freed up, the capacity to simply trade another day has been preserved. Because in the grand scheme of trading, preserving your capital so you can execute your next edge is the ultimate goal when things go completely wrong. The foundation is battered, yes, but it is stable. Which leaves us with a final, really vital question to ponder as we close out this explainer. What kind of discipline is required to rebuild consistency on the road to 10,000 cents? I mean, recovering from a 33% drawdown requires immense mental fortitude. It requires not revenge trading, right? Not over-leveraging to win it back quickly, but returning to the baseline strategy with a completely clear head. This next chapter is going to focus entirely on rebuilding from this stabilized foundation. Thank you so much for walking through this tough, incredibly transparent analysis with me today, because honestly, understanding the losses is exactly how we learn to survive them.